Alright, guys, it's Abe Forest here. Today we're going to be discussing about bonds and what bonds entail. From my own research and from the way things have been for quite a number of years now, bonds are the foundation of every financial market. People don't really put more concern about bonds. And do you know that bonds really determines so many factors or so many financial institutions, whether it's going to go up or down, whether it's going to be profitable or not. It actually relies on the bonds. And what exactly is bonds? Bonds is just like an IOU that corporate organizations or governments issue out to people in form of a debt. And for everyone that has a bond, or let me say a bond holder, it means you are trying to fund either a corporate organization or funding government expenditures. Let's use your United States of America as a case study. Looking at the bond market, it's well over $100 trillion, and it's a debt market for corporate organizations and governments. And I want you to know that bonds determines your mortgage rate, determines your pension funds, determine the movement of the stock market or even the cryptocurrency, or just mention any financial assets in this world, because the governments are in charge of bonds. And using the United States of America as a case study, United States of America has not run a budget surplus since over 2001. They really rely on debt, which is bonds. And these bonds, this has literally made the United States of America debt to range between $40 trillion. And the reason why this is increasing is because of the interest rate. Because we have the Federal Reserve, trying to increase or decrease the interest rate in order to curtail the economy, the growth of the economy, and at the same time curtail the debts that the economy is trying to go against. They don't want to attain so much debt. But at the same time, if you look at the debt rate to the GDP of the American government, it's over 122%. Because if you look at the GDP for America is 31.4 trillion, and the debt is 40 trillion. So that means that they've not run a budget surplus for over a decade now. So that means they've been running on debt, and it means that the government's revenue is not always enough. How do the United States of America generate their revenue? They generate their revenue through tax and tariffs. Major government revenue ranging from income tax, payroll taxes, excise duties or taxes, and also corporate taxes. I think the income tax is just 54%, and the payroll tax is just 30%. The excise tax is 15%, and the corporate tax is just 9%. Totaling all this together, it doesn't really allow the government, the United States government, to have a budget surplus since 2001. So that is the reason why they issue out bonds to banks, to pension funds, and also to insurance companies, and also foreign government, especially foreign government. In fact, Japan is one of the major US Treasury's customers, and some of the US citizens, like private individuals, and United States of America bonds is considered the safest asset in the whole world, which means that if you are buying bonds in the United States of America, you are guaranteed, your payment is guaranteed, your interest is guaranteed. For instance, you can buy the short-term bonds or the long-term bonds. When we talk about the short-term bonds, these are the treasury bills and the treasury certificate. Treasury bills is just 6 months, between 6 months and 9 months, and the treasury certificate is just between 2 years. depending on your risk tolerance, you can decide to hold the long term, which as the 10-year treasury bill, the 30-year treasury bill, and also the 20-year treasury bill, depending on the risk that is involved and the reward that is involved. For short term is lower, while the long term is higher. So for instance, if you are subscribing to the short-term treasury bills, so probably the rate is just I think 3 point something percent, and while the long-term treasury bills, treasury certificate or treasury yields is above 5 point something percent, depending on what you decide to do. So I need us to understand the fact that like I said, there have been budget deficits for quite a number of years in the United States of America, and that is due to the fact that their GDP is lower than their debt rate. So looking at that, let's look at what the constituent of what bond entails. We have the bond principal, which we call the face value. We also have the interest payment, which we call the coupon rate. If you want to buy a bond, they're going to ask you, you're going to determine, and bond is traded like stocks. The prices varies on the date that you want to buy it. It's not fixed per se, but if you are buying it at a particular price, then that means that is your capital or your principal, the bond principal, and there's always an interest payment that is always on each, which is called the coupon rate. And it will interest you to know that the bond prices actually is being determined by the interest rate. Interest rates, that is why the Federal Reserve, they usually come every month to determine the interest rate, because they don't want inflation. They use that to curtail inflation, at the same time curtail their debt rate. Like I was saying, like the new bond holders favors rate hikes, like those that are just coming in, but it doesn't really favor the old bond holders. So for instance, somebody bought a bond in the year 2025 and somebody is buying in the year 2026. The person buying in 2025 is an old bond holder, and the person buying in 2026 is a new bond holder. So if interest rate is being increased, it literally favors the new bond holders, because the interest that you will be getting will be going higher, which means that the demand for the bond is going to drop. And once the demand for the bond drops, then bond prices goes lower than, for instance, let's say $1,000. You understand? Probably goes lower to like $900 or $950. And in return, the bond yields goes higher than, let's assume that the coupon rate is 5%. So it usually favors the new bond holders if the interest rate is being hiked. But if the interest rate is being lowered, old bond holders, it favors them. That means that the demand for the bonds will increase. You understand? And once the demand for the bond increases, then bond prices goes higher than $1,000, and that's going to be like $1,100, and the bond yield goes lower than 5%. All right, so let's take a practical example. Let's assume that the price of a bond is $1,000, which is flexible. It fluctuates based on the increase in the interest rate, either higher or lower. Now, and the coupon rate is 5%, which is fixed and static, but it is moved based on the price that you buy the bond. So that yield, which is yield, you understand? Let's assume that the maturity is like 2 years, for instance. The yield is the only thing that is static, and for you to be able to calculate your yield, your current yield, you have to divide your coupon rate with the principal. Coupon rate divided by the principal. For instance, 5%, which is a coupon rate, the principal, which is $1,000. Now if you're going to be doing that, you'll be having 5%. It means that the coupon rate is fixed. You understand? So, but if the yield changes, it's going to be as a result of the interest rate change, which I'm going to use that as a case study now. Now, let's assume that the interest rate is being increased by the Federal Reserve, it means that the demand for the bond is going to reduce, because the bond prices goes lower than $1,000. You will notice that the bond yields goes higher than 5%. It means that the new bond holders will favor the increase in interest rate. That means that the interest rate is going to increase and the yields are going to increase in order to match the amount in which they buy the bonds. When there's interest rate increase, the demand for the bond is going to drop, such that the price is going to go lower than $1,000 that the old bond holders bought that bond. So something like $900. So if you now want to calculate your own yield, it's going to be your coupon rate, which is 5% that is fixed, divided by the principal that you bought the bond, which is $900, or let's say $950, $950, depending on the amount in which they buy the bond. So you notice that the yield goes higher. You understand? So which favors the new bond holders. Meanwhile, interest rate reduction favors the old bond holders. It means that the demand increases because the bond yields actually the bond prices goes higher than $1,000 to like $1,100. So which means that the bond yields has to go lower. Don't forget that the bond prices and bond yields are inversely related. Once the bond prices goes up higher, the bond yields has to come down. You understand? But if the bond price goes lower, then bond yields has to go higher. So looking at that, so it's just kind of like a seesaw, and the seesaw is just like the people that allow it looks like a seesaw is the Fed, with interest rate changes, either increase or decrease. So it's important that you understand how these things work. Why do all these things matters? It matters because increasing interest rate, though it's going to be increasing the debt rate of America, but at the same time it's going to affect your mortgage rate, your credit card, your retail sales and whatever. So, and the reason why the Fed usually increase the interest rate is not to curb inflation or to curtail the normal benchmark of 2% inflation rate. You understand, in America, which is, I think the CPI says that we have 3.8% inflation at the moment. So they have even gone above the benchmark, which is 2%. So the reason why they increase interest rate is so that they can curtail inflation. And you know what inflation does? When there's inflation in the economy, there's going to be a high rise in prices of goods and services, which tend to reduce demand for goods and services. So that's one of these why the Fed is there to manage this resources such that it's not going to affect the economy. So I think that's the major thing you need to understand about bond. And you can look at for this pictorial diagram that you can see on your screen for more explanation, or send me a DM if you want to learn more about how the bond market affects your stocks, affect your cryptocurrency, affects all the financial market as a whole. Because the government are the one, when the GDP is lesser than when the debt is higher than the GDP, it means that the economy is not the production rate is much more lower than the debt rate, which is not that good for an economy. You understand? So, and the more they increase the interest rate, that is the more the debt is going to rise even far above the GDP, which is not good for an economy. So that is one of the reasons why the Fed usually increase or reduce interest rates, so as to normalize the way the economy is. So to buttress my point, I told you initially that once the bond prices increases, the bond yields goes down, and once the bond yields goes down, the bond prices increases, vice versa. Now this is the bond yields, 2-year bonds, 2-year yield rather. Now you notice that for the past quite a month or so now, the the yield has been rising, increasing the debt rate of America, and the bond prices are literally coming down. You understand? Bond prices are inversely related to the bond yields. So if you look at it very closely, as the bond prices are coming down, immediately you see that the bond yields are going up higher. Now, the interest rate, is at the forefront of affecting all these things. And once the interest rate is being increased, it literally strengthens the dollar. It strengthens the dollar. Now, the interest rate has been increased, not increased, but it wasn't changed. You notice that the interest rate was not reduced, so it was just remained the way it's supposed to be. So which was 3.75. So it strengthens the dollar. So the dollar has been going up higher since the Fed had their FOMC meeting last week. So looking at it, the dollar is being strengthened as against every other basket of currency, like the JPY, the GBP, the Euro, the CHF, and the rest.